So for those of you who are new to our webinar series, this is a project of the Center on Budget and Policy Priorities, which is a nonprofit policy think tank in DC. This series is designed to help prepare advocates, assisters, state and local officials, and others to assist consumers access the Affordable Care Act's new health coverage opportunities. It is intended for those working on the implementation of health reform. Today's webinar will walk through several complicated scenarios to illustrate eligibility rules and how these rules impact people at tax time. So with that, to guide us through our topic today, please welcome Tara Straw, Senior Health Policy Analyst.
Hi, good afternoon, everyone. So today we're going to talk about some complex eligibility scenarios. You all bring us a lot of complex problems, and we're going to highlight a few of them so to help inform the whole group of the kinds of issues that you bring to us one by one. So we're going to start with an example on affordability. We get this question an awful lot. So you all are very familiar with the definition of affordability for the purpose of marketplace enrollment, and that's on the left. So in order to be eligible for APTC despite an offer of employer-sponsored coverage, the coverage needs to cost more than the lowest cost self-only plan needs to cost more than 9.69% of income. The definition of income will include non-tax Social Security benefits, and we're determining the cost based on employee-only coverage, no matter who in the household we're trying to figure out coverage is affordable for. But there's a different definition if we're talking about affordability for the purpose of exemptions, and this is where you all ask a lot of questions. So if we're talking about getting someone an exemption, whether it's through the marketplace or on the tax return, there are many differences. So first of all, the percentage is different. You can claim an exemption based on affordability if the plan costs more than 8.16% of income. The definition of income is different. In the tax world for exemptions, we do not include non-tax Social Security incomes. We only include the taxable amount of Social Security in household income. And what we're measuring is different. So instead of looking at the cost of self-only coverage for the employee, we're looking at, for a family member, the cost of family coverage. So for the purpose of exemption, there isn't the same family glitch that we see for the purpose of qualifying for premium tax credits. So with those definitions in mind, here's our example. This is Roberto, Monica, Elena, and Miguel. Roberto and Monica are married. They have 2 kids. Their income is $37,000, which is 152% of FPL. So when they come to you during open enrollment and they sit down with you, no one has enrolled in coverage yet for 2017. You ask them about employer offer of coverage, and they tell you, they give you, the handout from Monica's HR department, which says that there are 2 plans that are offered, Plan A and Plan B, and they each have employee only and employee plus family premium costs. The difference is that Monica really prefers Plan B because the preferred doctors in the network, but Plan B is not the lowest cost plan. So with this information in mind, you start to walk them through some questions to figure out if they would be eligible for premium tax credits based on the employer-sponsored insurance being unaffordable. So you ask, does the lowest cost plan that covers only Monica cost more than 9.69% of household income? And the answer obviously is no. It's only $100 a month. It's only about 3% of income. So Monica is not going to be eligible for premium tax credits with that offer of coverage from her employer. And the result is that Monica has decided that she's not going to enroll. She really sort of had her mindset on family coverage. So what about Monica's husband? Is he eligible for premium tax credits based on the cost of the coverage? So As a reminder, for her husband, we're going to still look at the lowest cost plan, so Plan A, and the employee-only premium. And this is really a classic illustration of the family glitch. And again, since it was considered affordable coverage for Monica, it's going to be considered affordable coverage for Roberto. And he also chooses he's not eligible for premium tax credits, and he chooses not to enroll in any coverage. So let's think about the kids. Will they be eligible for premium tax credits? And the answer, again, is going to be no, for the same reason as it was for Roberto. The difference here is that in the application process, you figure out that the kids are eligible for CHIP. And so the kids are enrolled in CHIP. So here's where we stand. We've got the parents who are uninsured, and then we've got the kids enrolled in CHIP. And they're going to get a Form 1095B at the end of the year to indicate their coverage. Parents are going to have nothing. They're uninsured. They're facing a penalty. So what do we do? Well, let's do a little reminder, a refresher about the exemptions that are available. At the time of application, so when you're going through all those rules with this couple, you should really consider eligibility for marketplace exemptions that a person might be eligible for right now, but could be forfeited if circumstances change. So in particular, I'm thinking about the Medicaid coverage gap exemption and the affordability exemption. So both of those are based on, at the marketplace, based on projected income. And so if you can tell based on someone's projected income that they appear to be eligible for this exemption, it's a really helpful practice to just help them claim it. For the Medicaid coverage gap exemption, make sure that they go through the marketplace application and get their Medicaid denial. So they can also get the exemption certificate number, ECN, to use on their tax return and claim that exemption. If they're not eligible for that exemption, consider the affordability exemption. If they're eligible at that time, it's best to claim it because by the end of the year, they may have had a change in their household, a change in their income that makes them ineligible for the exemption, and you've sort of missed an opportunity. But if neither of those apply, then you can consider whether a person might be eligible for another kind of exemption. And here's the list of exemptions for 2016, and we expect for 2017 as well. And then after that, you can think about whether someone might be eligible for a hardship exemption that's granted by the marketplace. A lot of the exemptions that are available on the tax return are quite easy to claim and often are for the whole year. Hardship exemptions can require some documentation, require an application. So you can certainly, if you know someone qualifies for one, you can certainly help them complete an application to help them claim it later on their tax return. So let's look a little more closely at the exemption based on lack of affordable coverage. So as we said at the outset, this exemption is available to someone whose cost of coverage, lowest cost employer-sponsored coverage, costs more than 8.16% of household income. And this exemption is available from the marketplace based on projected income. You have to apply for this during open enrollment or a special enrollment period. Or you can claim the exemption later if you're still found to be eligible on your tax return. But then it'll be based on actual income, and you'll claim directly on the tax return code A. So if you look at the box on the right, what is considered an affordable coverage, again, a reminder, if we're talking about, first we're going to start by asking if the person is eligible for employer-sponsored insurance. If they are, and it's the employee themselves, we're going to look at the lowest cost self-only plan for the employee and ask if it costs more than 8.16% of household income. If we're looking at an uninsured member of the employee's family, then we're going to look at the cost of family coverage and see if that costs more than that threshold amount. If there's no offer of coverage at all through an employer, then we're going to look to the marketplace and ask whether the lowest cost bronze plan, after any premium tax credits is taken into account, for non-exempt members of the taxpayer's family costs more than 8.16% of household income. So we're going to ask at the marketplace the cheapest possible plan you could have bought after you also subtract out any premium tax credits you could have claimed. Does that cost more than 8.16% of household income? So circumstances where you may want to consider an exemption, a marketplace affordability exemption in particular for your clients, and we're talking about claiming that up front during open enrollment or a special enrollment period, is really when you have these cases of family glitch and the offer is going to be considered affordable and block them from getting premium tax credits. But under the tax definition, the exemption definition would be considered unaffordable. Also, if the person sort of falls into that gap where their coverage costs more than 8.16% of income but less than 9.69% of income, it's a pretty narrow gap, but I'm sure that there are many people who fall into it. Also, if you have someone whose insurance looks affordable only because they also have someone in their family has non-tax Social Security benefits. So since the definition of income is different under the two calculations, then it's worth considering them for exemption. Also, if an applicant is between jobs and really you just cannot nail them down on an income amount, then immediately consider affordability exemption to at least lock in an exemption for them for the year. Also, a person might want to enroll in catastrophic coverage, and the exemption based on affordability is their ticket to that kind of coverage. So let's return to our family and see how they fare under the exemption definitions. So remember we had the parents, neither of whom enrolled in coverage, and the kids were covered by CHIP. So is Monica eligible for an exemption? And your question is going to be, does the lowest cost employee-only plan cost more than 8.16% of her income? And the answer is still no. The lowest cost plan that covers her was only about 3% of household income. So it's affordable whether we're talking about premium tax credits or the exemption. So she's not going to qualify for an exemption. We're going to need to calculate the penalty for her. We've determined that no other exemption applies. So her husband, is he going to be eligible for exemption? Well, here the answer is going to be yes, because remember, now that we're in the exemption land, we're no longer looking at whether Monica's plan was affordable. We're looking at whether the plan that's available to Roberto was affordable. And at 8.9% of household income, that's greater than the threshold amount of 8.16%. And so Roberto is going to qualify for an exemption based on affordability. And whether he applies for that exemption at the marketplace or later on the tax return, he'll still need to complete the Form 8965 to actually claim that on his tax return. And here's what it would look like. If he had applied through the marketplace and received an exemption certificate number, then that would go in Part A of the tax form. If he waited until he filed to claim the exemption, that would be in Part 3 of the tax return, Code A. So Monica, she is going to owe a shared responsibility payment, and there are two different methods for calculating the shared responsibility amount, and the amount that she needs to pay is going to be the greater of those two amounts. The first amount is the amount of income above the filing threshold. So the filing threshold for a married filing jointly couple was $20,700. It's 2.5% of income above the filing threshold. Now here we had to use the figures for 2016 because the 2017 figures for tax filing threshold and for tax filing threshold are not available yet. The second calculation is a flat dollar amount, so $695 per adult. And so that is the greater of the two amounts, and that's the amount that Monica would pay on her tax return when she files her taxes for tax year 2017. So we crammed just about everything we could into that example on affordability, and I hope that you all have some questions. We'll take questions at the end, but we know that we get a lot of questions on that, so we're ready. The second scenario is one of non-custodial parents. This is also a common situation when you've got two households who are really just trying to figure out how to get through this. So here we have Lisa, Jackson, and David. Jackson, the child, lives with his mom. Lisa is divorced from Jackson's dad, David. As part of the divorce agreement, Lisa and David alternate claiming Jackson as a dependent on their tax return, but he lives primarily with his mom. So Lisa's income in this example is $20,000. She also receives child support. David's income is $40,000. And we're going to assume here that neither parent is offered coverage through work. So I am not going to read our very complicated explanation of the Medicaid household rules, but I'll tell you that I have this table printed out and on my desk because many of the times when you all have questions for us that involve situations like that, I refer to this table. So you start with each person who is in the tax family, and we try to figure out what their household is. So it's really understanding the idea that there's not just one household that's going to be correct. It's actually we're looking at the household calculation for each individual in the family. And we're dividing people up primarily between tax filers and tax dependents. And then we're kind of catching everyone else with exceptions and the non-filer, non-dependent rules. So we're going to apply this because that's really the best way to understand it. Okay, so for this family, we've said that every other year, the non-custodial parent, David, is going to claim Jackson. So let's start with the custodial parent. So in the years that Lisa claims her son, we're going to look at Lisa's household. There are two people who are going to be counted in Lisa's household, Lisa and Jackson. And that's because if you look under the Medicaid rules, she's a tax filer. And for a tax filer, we include the filer and their spouse and dependent. So here we've got Lisa and Jackson. It's a household size of 2. For Jackson, if in the years that he's claimed by his mom, it's going to be a household size of 2. So for Jackson, we're going to look at the tax dependent rules, and he is in the same household as the tax filer claiming him as a dependent. So that's going to be 2 for him. And then David, obviously, he's going to be off on his own. He's a household of 1. So now let's consider what happens when David is the one who's claiming their son. So in this case, Lisa, even though Jackson lives with her, Lisa's going to be a household of 1 because she's not claiming Jackson's exemption. And that's, again, she's under the tax filer rules. It's the tax filer, so Lisa herself, plus the spouse and any dependents who are on the tax return. So since Jackson isn't on the tax return in these years that David claims him, Lisa is going to be a household of 1. In the years that David is claiming him, Jackson, let's figure out what Jackson's household size is for Medicaid purposes. So in this case, we're going to look at him as a tax dependent, but then we're going to look down to the exceptions under a tax dependent. And if you look down to the 3rd bullet, there's an exception for children who are under 19 who are claimed as a tax dependent by non-custodial parents. There's an exception just for this kind of case. And so under that exception, it says to apply the rules for a non-filer. So now we flip over to the non-filer rules, and we include in Jackson's household the individual, so Jackson himself, plus siblings, parents, and children living with the individual. Well, Jackson is living with Lisa. And so Jackson's household, even though he's being claimed as a dependent by his dad, is going to be Jackson himself and his mom. And David, in the years that he claims his son, we're going to look under David for the tax filing rules, and he's going to claim, or his household will be himself and his dependent on the tax return, so himself and Jackson. So those were the rules for Medicaid. And you know as we go through the application, we always start with Medicaid eligibility. So it's important to establish the Medicaid rules first. Now, if someone is not eligible for Medicaid, then the application is going to sort of reformulate the math to figure out what the household is for premium tax credits, and that's a little more straightforward. So in years that Lisa is claiming her son, Lisa and Jackson will both be a household of 2 because it's the tax unit. And David is going to be in a tax unit by himself. Now, in years that David, dad, is claiming Jackson, Lisa is going to be a household of 1, just herself, for the purpose of premium tax credits. And Jackson and David are going to be in a tax unit together, even though they don't live together, because they're going to be on the same tax return in those years. So that's easier. So if we take all of that information and we see what that looks like in FPL terms, then here's what we get. So in the years that Lisa is claiming her son, for Medicaid purposes, she's a household of 2, and that's going to put them both at 126% FPL. So that means that in a state that has expanded Medicaid, Lisa herself should be eligible for Medicaid as well as Jackson being eligible for Medicaid. But if we, and it's the same household formulation for premium tax credits. So I think we know where everyone stands. So Lisa and Jackson would be eligible for Medicaid in an expansion state or eligible for premium tax credits in a non-expansion state. And David would be eligible for premium tax credits either way. Now, if David is claiming his son, in those years, this is sort of the math for the household calculations we did earlier. So Lisa is going to be a household of 1, and her FPL at the same income level is going to be 170%. And so because she's not claiming her son, she is going to not qualify for Medicaid because it changes her position against the federal poverty line. Jackson is still going to be a household of 2, so he's still going to be Medicaid eligible either way. David is a household of 2 when he's claiming his son for Medicaid purposes, and he's out of Medicaid range, and so he would need to claim premium tax credits. So aren't you glad the computer does this? Does it make you feel better about all the questions they ask? This is what they're trying to get at when they're asking all those questions and dancing around. So what does this mean in the application itself? Well, in years, I think it's pretty clear when Lisa's claiming her son what the application is going to look like. But it gets a little trickier in years when David is going to claim their son. So in that case, when Lisa's filling out the application, she's basically going to apply for coverage on her own. And because but the questions are going to help her figure this out. We want to make sure that she has the right household size. So Jackson, there's a question that asks specifically about this kind of scenario. Does Lisa live with 1 or more children under age 19, and is she the main person taking care of that child or children? And the answer is yes. And then we're going to enter in Jackson's information. And so Lisa should include him on her application. Now for David, David is going to include Jackson on the application as both a dependent and an applicant. So the questions are going to ask about whether David's married, whether he has any dependents on his tax return, who are his dependents, and then ask where his dependent lives. And then it's going to give us some helpful guidance to say that Jackson might be eligible for Medicaid through the parent that he lives with. And that parent can file their own application. So it's trying to help us figure out where to place individuals on the application. Okay, that was a tough one. Now we're going to talk about increases in household income. And we're going to, of course, take the most complicated income we can find, which is self-employment income, which I know a lot of people still have questions about. So this is George. He's a self-employed carpenter. He hasn't filed taxes in a while because, just like you, he thinks it sounds very complicated. So he just doesn't do it, and the IRS hasn't found him yet. So here are some tips for dealing with self-employment income. It can be tricky to estimate income. I think that you need to kind of meet the person where they are. Like, different jobs have different income cycles. Like, someone might find it best to estimate income by the job. Some other people know their average weekly income or their average monthly income. For some people, it's more quarterly or seasonal. And so based on their job, you should, try to figure out what the appropriate time period is. So, we can be talking and trying to figure out the most accurate estimate. If someone doesn't have regular income, look at the jobs that they have lined up for the year. If they don't have any good projected estimate, then maybe start with last year's income. Now here, George said he doesn't really know how much he made last year either. So George is not being very helpful with us, but in other cases, people will have filed before. And so you can say, okay, well, it looks like you earned $30,000 last year. Do you think you will make more or less next year? You can also make estimates looking at people's bank records. If they have an account that's dedicated to this business, then you can see how much money they bring in by the month and by the year. Or perhaps they get paid in, like a carpenter might, on a job basis, but kind of in big checks. So even though it's in his personal account, you can really flag the ones that are income from the business. So we also have some advice on estimating expenses. My first piece of advice on estimating expenses, there are many types of deductible business expenses: advertising, commissions, contract labor, legal fees, office supplies, rent, telephone. A lot of people who are, quote, self-employed don't have these kinds of expenses. A lot of them are, maybe doing jobs for cash, and we have to call that self-employment. It's, we put it all under the same category, but really, often people don't have these kinds of expenses. Now, if someone has like a really kind of legit business, then they'll certainly have these. But if someone is doing something like mowing lawns or has, some side income like that, then I wouldn't pepper them for too many questions about estimating expenses, because they probably don't have any or couldn't produce records of them. But for someone who does have significant expenses, you can again figure out whether they're on a monthly basis, whether there are some just a couple of key large expenses that you want to keep track of. You can look at their expenses in the previous year, and just like estimating income, you can go back to credit card records, bank statements to see what their cost of supplies or other expenses are. But like I said, in many cases, people aren't going to have any expenses, and don't sweat expenses, because at most you would just not including expenses that someone will include on their tax return just leads to a slight overestimation of income, which is going to reduce the premium tax, the APTC, a little bit, but they can always get that back later if those expenses pan out. So after a lot of questions and a lot of hand-wringing, we figured out that this month George made about $2,000 after expenses, and we've decided that we're going to use that as a base for his income projection for the year. So we're going to say $2,000 a month. He thinks that's fair enough. So that's what we go with. Now he comes back to you in May because he just got this big job and he thinks it's going to increase his annual income by a fairly significant amount, by $5,000. He wants to report the change to the marketplace. He asks you for help doing that. And this is actually the main focus of this example, which is what do we do when someone reports that change and increases their income? So here his original income projection was $2,000 a month. That's $24,000 for the year, or just over 200% of FPL. Based on his new projection, he would earn $29,000 for the year, or 244% of FPL. So the regulation that governs the marketplace calculation of the APTC had a really good idea, which is that we're going to, when we change the income, when someone updates their income, we're going to figure out how much they're entitled to receive for the rest of the year after subtracting what they've already received. So at the beginning of the year, he was receiving $237 per month. Based on his recalculation, that should the annual amount should be $2,099, but we need to account for the APTC he's already received. So we need to subtract out APTC from January through May, and that gives us a new amount, $914, that we need to apportion throughout the next 7 months. So that would be $130 a month. So that's what the regulation says. Unfortunately, that's not what healthcare.gov does. Because that's kind of a complicated concept that they've just not been able to make work in the technology. So healthcare.gov is going to do it a different way. Now, the way that I just described, which is in the regulation, is in the center column. So that's what happens when you take into account the amount of APTC that was already received. Because you start with this with the $237 a month, then based on the new income, you have $130 a month, and the total APTC is going to, works out precisely like that. Well, the way that it currently works in healthcare.gov, when you report the change in income, it is going to calculate the APTC based on your new income without accounting for the excess that you received in prior months. And so instead of giving George $130 a month for the remainder of the year, they're going to give him $175 a month for the remainder of the year. And so that's going to mean that he'll receive a greater amount in APTCs than he should have, and he's going to owe some of that back at the end of the year. And the reason for that is just because they didn't account for how much APTC he had already received in the year. They were calculating his amount based on 244% of FPL without thinking about how much he'd already received. They were just like starting fresh. But then the math works out that he's going to need to owe some of that back. Now, so that's pretty bad, but I do want to point you to the first column. So even though it didn't work out exactly right for George, it's a shame that he took the time to report and he still owes money back. But look what would happen if he hadn't reported at all. He would have continued to receive $237 a month all year in APTC. He would have had total APTCs for the year that were $747 more than he should have received. And so even though the way healthcare.gov does it doesn't, completely protect George from overpayment, at least he doesn't owe, he would owe more than twice as much if he had not reported at all. So it does get him closer to accurate, but not 100% there. So the way that you can help someone who has a change in income that increases their income is to try to account for that by taking less APTC than they are entitled to. So if you're entitled to, if George is entitled to take, according to healthcare.gov, $175 for those remaining months of the year, you can cheat him down and say, okay, but can you take less than that full amount? Because if he gets closer to the $130 a month, then he's going to owe less at the end of the year. So I'm not saying that you should do the math on all of this yourself, although you certainly could, to figure out what the the optimal amount of APTC would be. But it certainly would help to kind of steer people who have those increases in income to a lower advance credit, because you're just protecting them from overpayment. All right, so this is our last scenario, and then we're going to take your questions. This is another very taxi scenario. So we've got Katie. She is 22 years old. She's a full-time student. She lives on campus, but near her parents. She does a work-study job where she has a little bit of earnings, and she has tuition. Her tuition is paid through a combination of scholarships, her parents, and a Stafford loan that's in her name. So Katie's parents are Jay and Priya, and they earn $45,000 a year, and they help to support their daughter, Katie. So first we need to figure out, they're all uninsured, they're all looking to you for help. So first we need to figure out if Katie is going to be a dependent. And you're familiar with these definitions now of dependency. You ask Priya and Jay, are you going to claim Katie on your tax return? And they look at you with question marks in their eyes, and so you need to go through all the questions. So Katie is their child, so check that box. She's a citizen or resident of the United States. Does she live with them for more than half the year? Well, she lives away from home, but she's attending school, and so that's considered a temporary absence. So she's still considered to be living with them even though she's at school. Is she under 19 at the end of the year, or 24 if a full-time student? Well, we said she was a full-time student, but she's 22. This might be her last semester in college, and so she's not a student all year, but that's okay because full-time student really means only one semester. You have to be full-time for at least 5 months of the year. And then our final requirement is that Katie doesn't provide more than half of her own support. Well, support includes educational expenses, and loans in Katie's name will be considered support that she's providing. So support is actually kind of a difficult question, and I think we are going to need to break it down. So these are the elements that constitute support under taxes. It's housing and utilities, food, clothing, education, and other things that the kid needs. So we have to estimate what the total cost of these things are, and then what's Katie's share to figure out whether she might be a dependent. So you can see that we've estimated her cost of housing, her cost of food, her cost of clothing, education, and then some other expenses. And the cost of being Katie is about $22,000. Katie only pays about $7,000 toward the cost of being Katie. And a big chunk of that is coming from her education, because we said that she had a Stafford loan in her name, and a loan in her name is considered support she's providing. So that $3,000 was a loan, but she's responsible for paying it back. So it's got her name on it. So we think that she'll be providing about 32% of her total support. Since she's not providing more than half of her own support, Katie is likely to be a dependent of her parents. So for our purposes, we're going to say yes. Katie's paying less than 50% of her own support, meets all the other tests, she's going to be a dependent. Okay, well that's good news, because that means we're doing one application instead of two. And they all apply for health coverage. They, as a tax household of 3, because they're all in the same house, tax household for purposes of the application. Based on their income, Katie doesn't have a tax filing requirement based on her, very little income. So we don't include her income in their household income. And Priya and Jay, we said earlier, earned $45,000. So that's what the premium tax credit is calculated on. They all enroll in the Silver Benchmark Plan, just to make this less complicated. And their monthly premium cost after subsidies is $272. But oh, Katie, she's so enterprising. She got a job, and she ruins everything. So she was working at a restaurant during the summer, and she earned an additional $7,000. She decides to use that money to pay the rest of her tuition for the fall semester and to pitch in for other expenses. So by the end of the year, we're looking at how much Katie is paid. And it turns out that Katie has actually paid more than half of her own support because she put that money toward education, toward rando expenses, toward her food, toward housing. And so now that she's paying more than half of her own support, she's not her parents' tax dependent. But what do we do? Because we've got a 1095-A that is going to have Katie and her parents on one form, but they're not on one tax form, and that creates some problems. So how are Katie and her parents going to resolve this? So previously, they had a projected household size of 3 at an income of $45,000. At the end of the year, Priya and Jay have an actual household size of 2 on that same income. And Katie has a household size of 1 based on her income. It was her work study plus the summer job. So here's what their situation was at enrollment. Family size of 3, 223% FPL. But when Katie's not a dependent, they have to file taxes independently. And so they'll do it as 2 separate households. So what happens to the premium tax credit? Now this is a very kind of complicated tax issue. So we're not expecting you to learn this, but we get a lot of questions about, well, but what happens if? And I feel like we haven't, there isn't any information from the marketplace about this. And so you sort of fall into like an abyss of like just not knowing, like never knowing how this resolves. Well, we're going to show you how it resolves. And it resolves from these complicated tax rules called the shared policy allocations. And the shared policy allocations look at all of these different reasons that people might be on the same 1095-A, they might have enrolled together, but they might end the year separately. So the prime reasons for that would be divorce and separation, where you start the year very happy, and then you end the year less happy, or maybe happy with a different person. So we've got to figure out some rules for how we take that one 1095-A and we carve it up between people. But we're going to look at the rule for the third column, which is a shifting enrollee. So Katie is a shifting enrollee, and the definition is there at the bottom of the table. It's when a person is included in one household at the time of enrollment, but is in a different household or their own household at tax filing. So that describes Katie. And using this table, what to allocate, we're going to allocate the premiums that were paid, we're going to allocate the benchmark, and we're going to allocate the APTC. Those are the 3 columns on your 1095-A. That's the heading of the 3 columns. And how are we going to allocate it? Well, the rules say we can allocate it any way we want. We can have mom and dad pay for everything and Katie pays 0. We can have them split it 50-50. We can have Katie reconcile all of it. And if they can't agree, if mom and dad differ from, Katie, or they do their tax returns separately, and the IRS gets to, start fiddling with it, the default is a proportional amount. So let's look at how this can work out for Jay and Priya and Katie. So here is their end of year premiums. It was over $15,000 in premiums, and their benchmark is the same since they took the benchmark plan. And they received almost $12,000 collectively in APTC. So under a shared policy allocation, they can allocate any way they want to do. And since Katie is the lower income person, and just separate this from taxes, if someone has lower income, they're getting a higher subsidy, right? Well, the same is true at the end of the year at reconciliation. So if Katie were to take none of the allocated premium and just leave it all up to mom and dad to reconcile, then mom and dad are going to owe money. They're going to owe money because they went from being a household of 3 to a household of 2. So now they're at a higher FPL. So when they reconcile, they're going to owe money. They're going to owe some of that APTC back. If they do it in a proportional way, with Katie paying a third, mom and dad paying 2/3, they owe back even more money, mom and dad. But Katie gets a little refund. And if they do it so we allocate 100% of the premium, benchmark, and APTC to Katie, then Katie is actually going to get a really substantial refund. And mom and dad aren't going to be responsible for any of it. They're going to, partially fill out their 8962, check a box, and say, hey, Katie did it. Look at her return. And it works out really well for Katie, and that's because Katie has a much lower income level. So instead of being over 200% of FPL, Katie is at like 80%. And so when you do the math on her tax form, she is going to get a really sizable refund back. So there are a lot of potential ways to resolve situations where the tax household at the end of the year is different than the tax household at the beginning of the year. There are fewer options in the case of people who are separated, because that's, it's kind of a dubious thing. So there, if you look back at that table, there are fewer options of what to do if someone is just separated. Divorce works out more similar to the shifting enrollee scenario. It's important to know also, I know many of you refer people to VITA or the AARP TCE program. Shared policy allocations are out of scope for those programs. And some programs, I think we're doing them anyway, even though they are out of scope. But now I think our new software as of now, it doesn't even allow us to do it. So that's probably not so much of an option. But we just wanted to show you some of the scenarios about how that could work out for a family in this situation. And with that, we've got some time for questions.
Yeah. So to go back to your point about how shared policy allocation is out of scope for sort of the volunteer tax preparers, do you have any advice on where people should go if they have questions about this? Any advice?
Well, this is just my personal point of disagreement, is that I don't think it should be out of scope, because I don't think it's all that complicated once you really get into it. The rules are not that complicated, not compared to something like the affordability exemption, which we muddled through first. So I would first start with the instructions for the tax form. So start with the Form 8962 instructions. There's a whole section on shared policy allocations, and I think you can pretty much figure it out. Like, I know that, certainly as an assister, you are not a tax preparer. You are not supposed to help someone with their tax return. But if you point someone to the instructions of the tax form, they may be able to just do it themselves. Otherwise, they may have to see a paid preparer.
All right. Going back to someone who has fluctuating income. Mm-hmm. So if they're sort of here at open enrollment and they have a steady monthly income right now, but they're pretty sure it's going to go down mid-year, mm-hmm. Is it sort of better to assess the income as having that steady monthly income that they get now for the whole year and then report that change when it happens? Mm-hmm. Or is it better to try to say your monthly income is something lower, try and spread it out over the entire year to get a more accurate picture of what your annual income will be? There's not really a right answer to this.
Well, yeah, and I think that if you asked different people, you'd probably get different answers. So I would want to know, how sure are we that the income is going to decrease? Because I don't want to underestimate income. I never want to underestimate income, because that's just going to lead to a repayment at the end of the year. So when in doubt, I would estimate up as long as someone can afford their premium. I don't want to put someone in a position where we've estimated their income at a level where they're getting so little APTC that they can't afford their premium. I don't want to do that. But when in doubt, I would estimate a higher income, and then if there's a significant change, then we can go in and change it. But I really want to avoid people having large repayments at the end of the year. It's too painful. And it really cuts out of people's earned income credits and other tax benefits.
And someone had a question where when they change income information outside of open enrollment, they're reporting the change. The eligibility determination notice shows that they are unable to enroll. And so they were just curious if that means the person is going to lose coverage, or if the marketplace is simply just updating the income in the application and that the PTC will be adjusted and they'll stay in that plan. And let's say that they change their income, still eligible for premium tax credits. So that hasn't changed.
Well, it depends, like so many things. So it depends on whether the change in income that you're reporting is so great that you're also triggering an SEP, right? So that's where I'm not exactly sure where the question is headed. So you can report a change at any time, and a change, even a minor change, you can report if you choose to. But if you report a change that's fairly substantial, you might trip over one of the cost sharing reduction amounts. And so if you have a change in your cost sharing reduction amount, then you will have the option to choose another plan. There are consequences to choosing another plan, of course, if you do that mid-year. So if you had been in a plan and you had, met the deductible or had been well on your way to meeting the deductible, and you take that SEP opportunity that you were given because of the change in cost sharing reductions to enroll in a different plan, then you just zeroed out your deductible, versus enrolling in the same plan, again, re-enrolling in that same plan. In that case, any spending you had done toward the deductible would be carried over and reflected as it should be in your under your new cost sharing plan.
All right, and now going all the way back to our affordability example. So for the offer of ESI and how it interplays with the affordability and exemption, if an employee is offered two plans, if one plan is under the affordability threshold and one plan is over, is the employee eligible for an exemption?
No. No, because in both cases, whether we're looking at your eligibility for premium tax credits despite an offer of employer-sponsored coverage, or if we're looking at exemption through the marketplace or an exemption on your tax return, in any of those cases when we're looking at affordability, we're always looking at the lowest cost plan.
And then we'll do one more question. Okay, what happens in a situation where mom and dad are divorced? Mom provides insurance for the child through her work, but dad claims the child on his taxes. Dad wants to apply for coverage in the marketplace. Does he put the child on the application?
Well, I mean, we would go through the household rules for this family. Because it doesn't matter whether the child has health insurance from another source, we're still going to look at the household rules. So, and we would start with applying the Medicaid rules. Under the Medicaid rules, the child would be included in dad's household. This is where I need my chart in front of me. And if their income is such that they aren't qualifying for Medicaid, then we look at the premium tax credit, in which case the son who is claimed on dad's tax return is going to be a part of the household for premium tax credit purposes. So it's still the same analysis where you start with the Medicaid rules, then you move to the premium tax credit rules, and it doesn't matter that the kid already has coverage through mom. We're still just determining the household.
And essentially, too, you add the kid on the application as a non-applicant because he has coverage elsewhere. You always want to include him because dad is claiming him, so he is a part of that household.
Yeah, you want to luckily, the application questions in, 99% of the scenarios are going to get you there. So if you just answer the application questions, in the order presented, then they're going to get you to a place where where dad is entering the information for the kid that he's going to claim on the tax return, even though the kid has other insurance, even though the kid lives with mom.
And with that, I think we're going to bring this to a close. Thank you so much for joining us today, and we will see you next week. Thank you.